Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Applied Digital.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
All right, so with Applied Digital, I think the first thing we really have to establish is that this is not the same company it was, like a year and a half ago?
Not even close. You really have to forget the old story. This is all about a really rapid and successful transformation. They've moved from being a pretty low-margin crypto hosting company to, well, a pure-play infrastructure winner for the AI wave.
Okay, so let's unpack that pivot.
Yeah.
Because that's the engine behind everything, right? They moved away from, just hosting Bitcoin miners.
Exactly.
And went all in on high-performance computing HPC and these dedicated AI data centers. And this wasn't just a small tweak.
No, it was a complete retooling of the business. And you can see that inflection point happening right now in the financials. It's pretty stark.
How stark are we talking?
We're talking explosive.
Yeah.
I mean, if you look at the last couple of quarters, Q2 and Q3 of fiscal 2025, quarterly revenue growth was over 200%.
200%.
Yeah. That's a massive demand signal. Specifically, Q3 revenue jumped 84.3% year over year. That's $64 million. These aren't just little improvements. It's a fundamental change.
So what gives investors confidence that this isn't just, a temporary AI hype bubble? Because great quarterly numbers are one thing, but a pipeline is another.
And that's the key. It's the revenue visibility. Applied Digital has secured an enormous long-term contracted revenue backlog. We're talking over $16 billion.
Whoa, $16 billion. Just hang on. That number alone, it changes everything.
It absolutely does. You have to let that sink in. That figure completely anchors the investment thesis. It de-risks the story in a huge way.
And a huge chunk of that is from one client, right?
A huge chunk. The expanded deal with CoreWeave is estimated to be worth around $11 billion by itself.
Okay, so you have a massive investment-grade client basically committing to a decade or more of business.
Exactly. And that's why the future forecasts feel less like speculation and more like, an inevitability. The street consensus reflects this. They're expecting revenue to more than double to over $308 million in 2026. That's a 114% jump from 2025.
And it keeps going from there.
Oh yeah, doesn't slow down. The year after, they expect another 71% jump, pushing them past $500 million in revenue to about $528 million in 2027.
Right, so that brings us to the next big question, which is the competitive moat. Why them? Why is Applied Digital getting these massive multi-billion-dollar deals and not, the established data center giants? What's the secret sauce here?
It really boils down to one word: optimization. They're not just offering generic space in a warehouse, which is what a lot of the older firms do. Their advantage is that they design these AI-optimized data centers from the ground up.
So what does AI-optimized actually mean in, physical terms?
It means they're built for one thing: handling the insane power demands of high-density compute. Think about the latest NVIDIA GPUs, the H100s or the new Blackhawks. They draw a staggering amount of power per square foot.
Way more than a traditional server.
Way more. Legacy data centers just weren't built for that. They can't handle that density without incredibly expensive retrofitting, if they can do it at all.
So Applied Digital is essentially building something that's mandatory for these top AI firms. And that's where I've heard their cooling tech comes into play.
That's the critical piece. To manage that density, you need specialized systems. They have their own proprietary liquid cooling solutions built in from day one. That lets them support densities that are maybe 3 or 4 times what a standard provider can handle. It's huge infrastructure edge.
Okay, but hang on. Aren't the hyperscalers, your Googles, Amazons, Microsofts, aren't they building their own AI data centers? How do you compete with that?
That's a great question. And yes, they do build a lot themselves, but they also need to outsource, especially when they need specialized capacity, and they need it fast. Applied Digital is building a 600-megawatt pipeline of these power-dense facilities.
600 megawatts. What's a good comparison for that?
It's enough to power a medium-sized city, all of it dedicated to AI.
And we're seeing that capacity actually start to come online now, which is a big catalyst.
A huge one. We just saw phase 2 at their Polaris Forge 1 campus, the first 100-megawatt building, become fully energized and ready for service. That immediately starts to unlock that contracted revenue.
And they're being smart about where they build, too. It's not just about the tech, it's the location.
Right. Building 600 megawatts costs billions, so they're mitigating those costs by putting their campuses in strategic rural areas. Think the Dakotas. Places with access to stable, low-cost power grids.
Which also helps with the whole ESG narrative, I imagine.
It's a huge selling point. They're targeting a power usage effectiveness, or PUE, of 1.18. For anyone listening, a PUE of 1.0 is perfect, so 1.18 is absolutely world-class. It means very little power is wasted. And they're aiming for near-zero water consumption, which is massive for hyperscalers with sustainability mandates.
Okay, so the bull case is clear. You've got massive contracted revenue, a real technical moat, and best-in-class efficiency. But building an empire this fast is incredibly expensive. Let's flip the coin. What's the financial cost of being this aggressive?
And that's the single biggest risk for investors. Profitability. Despite that spectacular revenue growth, they are still deep in the red.
Because they're spending faster than they're earning.
Exactly. For fiscal year 2025, they posted a net loss of $233 million. It's just the necessary cost of a massive front-loaded infrastructure build-out.
And that means their free cash flow must be pretty rough.
It's significantly negative, yeah. You can't build 600 megawatts of cutting-edge facilities without huge capital expenditures. So this growth has to be financed, and it's financed with pretty aggressive leverage and capital raises.
Let's break that down, because I think the strategy here is key. They took on massive debt, but only after they had the guaranteed contracts to back it up.
That's the clever part. They just did a major $2.35 billion senior secured notes offering, basically a huge loan secured against the data centers themselves. And they could get that financing because the lenders can see the $16 billion in contractual revenue lined up to pay it back.
So the debt is high, but the revenue visibility is, as you said, unprecedented.
Right.
But then you have the dilution risk, which always makes investors nervous. We saw an S3 filing for more shares and warrants. For anyone listening, what does that mean in simple terms?
In short, it means they're preparing to sell more stock to raise cash. It increases the total number of shares out there, which, dilutes the value of the shares you already own.
That sounds bad on the surface. Why isn't the market panicking?
Because it's what you'd call managed dilution. The cash they're raising is going directly into building the projects that are already backed by that $16 billion backlog. So the market seems willing to tolerate a little dilution today if it unlocks billions in guaranteed revenue tomorrow.
Okay, so summarizing the risks, you've got the cash burn, the high debt.
Yeah.
What are the big existential threats here?
I'd say there are two. First is just massive execution risk. Building this much, this fast is incredibly complex. Any significant delays or cost overruns could crush their margins and investor confidence.
And number two would have to be customer concentration.
Without a doubt, being so heavily reliant on a few clients, mainly CoreWeave, is a vulnerability. If anything happened to that relationship, the impact would be devastating.
All right, let's pivot to the stock itself. Because despite all those risks, the stock has been an absolute rocket. It's up over 270% year to date. But with that comes volatility.
Staggering volatility. It has a beta of over 7, which means it moves about 7 times more sharply than the overall market. It's not for the faint of heart.
And we just saw a bit of a pullback?
Yeah, about 9.4%. It seems to be some profit-taking mixed with those dilution fears we talked about. The stock's now trading about 21% below its 52-week high. But a lot of analysts are seeing this dip as a constructive buying opportunity.
And the general sentiment is still bullish.
Overwhelmingly. You've got price targets ranging up to $41, all citing that revenue acceleration. And you're seeing institutional money follow.
Right. I saw Headlands Technologies increased its stake by, over 700%?
767.8% in Q2. Yeah, that's a huge vote of confidence.
But let's play devil's advocate here. We also saw over $11 million of insider selling in the last 90 days. How do you square those two things? Insiders are selling while institutions are piling in.
That's a fair challenge. I mean, when a stock runs up 207%, you expect insiders to take some money off the table. It's often just standard diversification or cashing in on vested options. The key is that the institutional buying is far outweighing that selling. It suggests the smart money is more focused on the $16 billion backlog than on a few director sales.
Okay, that makes sense. So looking forward, what are the near-term catalysts? Say, in the next 3 months, what should we be watching for?
It's all about earnings and operations. The next earnings reports in late January or early February are critical. They absolutely must show continued strong revenue growth from these new AI leases coming online.
And updates on the construction pipeline itself.
Absolutely. Progress reports on that 600 megawatt build-out are key. Any hint of accelerated timelines, or even better, an announcement of a new hyperscale client would be a major catalyst.
What about speculative buzz? Any unconfirmed rumors floating around?
The chatter is mostly around expansion. There are rumors of new lease wins, maybe even in Europe, which would be huge, and some
Yeah.
talk of M&A, maybe acquiring power assets to speed up their growth even more.
So let's bring it all home. What's the final crystallized investment thesis for someone looking at applied digital right now?
I think the thesis is pretty simple. This is arguably the purest way to play the AI infrastructure build-out. The value is driven by that unprecedented $16 billion backlog and their 600 megawatt capacity moat.
And the risks, the debt, the cash burn, that's just the price of admission for this kind of hyper-growth story.
Yeah.
But it's a risk that's being managed against guaranteed long-term contracts.
Exactly. The question isn't if the demand is there. It's confirmed, it's contracted. The only real question is operational.
How quickly and how perfectly can they execute on this massive build-out?
That's it. So the big question for you is, given the incredible revenue visibility from those multi-billion-dollar hyperscale leases, how quickly can the company execute its complex 600 megawatt build-out, and what happens to the stock if they hit their targets ahead of schedule? That operational execution is what truly translates potential into profits.
Absolutely. If you found our breakdown of Applied Digital useful, please hit subscribe and follow us for more Smart Wealth analysis with Joshua. We'll be back tomorrow with another Stock Dive.